Morning, everyone, and thank you very much for joining. This is the morning market review with myself, Russell Shaw, my senior market specialist at FXCM. My email address rshaw@fxcm.com. And if you need to email me, that's obviously the best way to do it. Today is Friday, and it's the 10th of June, 2022. Just going to go ahead and bring up our high risk investment warning. I'm going to keep this on screen for a few moments. And then I'm going to bring up the commentary disclaimer, which I'll in fact do right now. Okay, and let's go ahead and bring up our references. Market Scope 2.0. We're going to start off as we usually do, just going through the CNBC morning article, and we're going to look at TradingView this morning as well. Now, what I want to take a look at is this chart with you in a moment. But let's just go through the CNBC article, which has the following headline: European markets set to retreat after ECB meeting, U.S. inflation data ahead. So the ECB meeting yesterday was very, very interesting. I think for the last year and a half, it's been a complete sort of dare I say a snooze fest. I mean, yesterday it was an exceptionally important meeting. Let's just go through this article. European stocks are set to fall slightly on Friday as investors digest the European Central Bank's latest policy meeting and look ahead to its key U.S. key U.S. inflation print. The ECB on Thursday confirmed its intention to hike interest by 25 basis points at its July meeting, with a further hike expected in September, the scale of which is to be determined by data, by the medium-term inflation outlook. And I think that was fairly congruent with what the market expected. The central bank also raised its inflation expectations for the Eurozone significantly and downgraded its growth forecasts. European stocks fell sharply on Thursday in the hours after the decision, and ECB President Christine Lagarde's press conference, and during ECB President Christine Lagarde's press conference, and they expected to continue to slide on Friday morning. So we'll take a look at the DAX chart and see if we agree with that. Global investors are also looking ahead to May's consumer price index, which is coming out today at 12:30 GMT, which is 1:30 UK, 2:30 ZA. So we're going to have to look at, we must look at DAX, we must look at the Bund, okay? We must look at inflation as well. So that's on the agenda for this morning. Okay, economists are expecting a moderation from the May print, or expected to slow slightly from the May print. So we want to just keep an eye on that. If the report matches expectations or shows slower increases in consumer prices, Wall Street could deduce that inflation has peaked and the Federal Reserve may need to be less aggressive in its monetary policy tightening later in the year. Fair enough, we still want to examine that, okay? U.S. stock futures moved slightly higher in early pre-market trade on Friday ahead of the highly anticipated report after stocks fell sharply during Thursday's regular session. Now, I don't think there's going to be much movement this morning. I think this CPI data is very much a highlight of the week. I think once that comes out, the volatility will increase substantially. So just be aware of that. Shares in Asia Pacific were mixed on Friday as Chinese inflation data for May came in largely in line with expectations and investors turned their attention to the US. Back in Europe, the Central Bank of Russia holds its key rate meeting and announces its latest interest rate decision on Friday. Data releases today include Spain's May inflation print and Italian industrial output figures. Okay. Alrighty. So what we have here on the screen is the initial jobless claims, and using TradingView now, you can see it came in. Yesterday's figure is 229,000. It's a weekly series. Okay, so we get the initial claims for every. I mean, obviously we're a week behind, but that's the data as it's released. And in fact, there's also continuing jobless claims, which should be examined in tandem with this. But again, I think this is going to do the job nicely in just highlighting potential worries. And the first thing to note is that, well, the miss, the 229,000, has put the weekly stochastic into its upper quintile. Okay, so that's obviously dangerous, because if it maintains this this level above 80, well, then we're going to see initial jobless claims increase. Well, that's not good, right? We'll explain why in a moment. Take a look at, now this is a simple moving average. The screen, I didn't want an exponential, I wanted a simple moving average. All I wanted to know is, where is the current data? And this is 12 weeks, just by the way, because this is a weekly chart. I put it as 12 because I wanted a 3-month moving average. So this green line is effectively the 3-month moving average. Jobless claims are now above the 3-month average. Okay, we're above the 3-month average. Okay, that to me is a worry. We're above the 3-month average, and our momentum is now increasing quite dramatically. Look how it's jumped from the lower quintile to the upper quintile. Not much sort of movement between the 20 and 80. It's just bang, it just jumped across. That to me is now a concern. And the obvious question is, well, why is this a concern? And it comes back to our whole thesis that we've been talking about in terms of the unemployment rate, U3, versus the Fed funds rate. Okay, so I'm going to just make a few adjustments to TradingView, and what we want to bring up here is the unemployment rate. Remember, this now is U3. It's a narrow reading of unemployment. It's okay for our analysis. Okay, it's a proxy for general unemployment. All right, so this is, and we just changed this to a monthly because unemployment is now, unlike initial claims which are weekly, unemployment is released on a monthly basis. And if we take a look at all our data, so we go back, we've got the, I would suggest we've highlighted this area here. Why have we highlighted this area? Because it's fairly close to the supply shocks we're experiencing. So the 70s, early 70s, late 70s had 2 supply shocks, and they were both oil supply shocks. But we've got an oil supply shock now, so it does have a similarity. Let's bring in the Fed funds rate here, and we're using this as a proxy for rate increases. All right, and let me just make this bolder. And now we're going to draw the sort of parallel to deepen the analysis. If we go back to the first oil, if we go back to the first oil shock, it's here. Okay. When I've got to just rephrase it. When I say the first oil shock, I'm not getting the timing of the actual oil shock announcements. What I'm looking at is the movement of rates relative to unemployment at the time that the first shock is unfolding. And you can see when the Fed funds rate overtakes the unemployment rate, the Fed funds rate is this orange line, unemployment's this black line. Even though unemployment's dipping here, as soon as we have this crossover, it doesn't take long for the unemployment rate to start creeping up. Okay, so the crossover here is, I think, a signal. Also, the unemployment rate generally is a lagging series. Okay, so the lag over here makes sense. Okay, initial claims is not lagging. Initial claims coincident. Okay, let's just carry on here. Okay, here's the second oil shock. Again, take a look what's happening to unemployment. Unemployment's coming down, but as soon as we get this crossover, there's a lag, and then that unemployment starts moving up. Okay, now we go to present day, and you can see that we've got this crossover here. Okay, now the obvious question is there going to be a lag, and is the unemployment rate going to go up? Because that kind of hurts the soft landing thesis, doesn't it? And then if it defeats the soft landing thesis, which I think that's kind of going mainstream, then the question is, well, how deep is the hard landing? That's the sort of the follow-on question. So we've got this kind of interesting. We've got this kind of interesting chart over here. Let's link it to the missing initial claims. So, and the way we're going to link it to initial claims, we're actually going to get rid of Fed's funds rate, because I think we understand the effect that Fed's fund rate has on the series. Let's get rid of it. I don't think we need it. But we must now address this lag. There seems to be some sort of lag. Okay, so we must bring that into our analysis. And I think the way to do it is to actually now go back to the initial unemployment. Let's go back there. And something that I saw yesterday actually was interesting, and I want to show you guys. Let's just go initial unemployment. That's not right. Where is this? Initial. There it is. Okay, let's go here. Right. Let's bring back that stochastic. Let's bring that back in. Okay, let's just bring that stochastic back in. Indicators. Okay. So just to understand, so now we're actually looking at now we're looking at jobless claims on a monthly scale. But just to reiterate what we said, it's gone. The weekly scale's gone into its upper quintile. I've taken off the moving average, but we're above the 3-month moving average, a simple basis. So again, the job market looks to be moving. And what did we see in terms of the Fed's fund rate crossing over the U3 rate? Okay, so we're kind of trying to marry all these series together. We know that U3 is a lagging indicator. So let's add in U3. Okay. And again, let's just bold this up. All right, now let's just understand what we're looking at here, because I'm about to do something. We've got the stochastic on the as the indicator. That stochastic, it doesn't apply to unemployment. It applies to the initial jobless claims. Okay. And we also know that there is a lag for unemployment. Well, let's not look at jobless claims. Let's take jobless claims out. So now I'm looking at the initial jobless claims stochastic, but I'm applying it to the unemployment rate. Yeah, do you see what I've done there? I hope you guys sort of understand that, and I want to go back to the monthly. I'm looking at the initial jobless claims, which is a coincident indicator. I'm applying it to U3, which is a lagging indicator. Okay, so I hope that makes sense. If it doesn't, obviously just let me know. But now that we've got that, watch this, which I thought was quite interesting. Let's go back to the stochastic. And I want to add in this middle band here, a 50, which we never look at. We never look at it, but let's add 50 in. And this actually becomes a very interesting analysis now. I don't want a dashed line, I want a full line. Yeah. All right. Now, take a look at the first crisis. Okay. Look at when the stochastic for the initial claims takes out 50, that's when unemployment starts kicking up. Okay. Let's go to the second crisis. When the stochastic for initial claims hits over 50, that's when unemployment kicks up. Okay, we're quite far from that, but it now gives us a yardstick. All right, so there is certainly an argument to be made that the U3 rate is not going to increase. Well, there's an argument to be made that unemployment is not going to increase. Why? Because it lags. It's a lagging indicator. Okay, it's after the fact, right? So we will need to now focus on the coincident indicators, which are the initial claims and the continuing claims, because we've got that weird crossover between the Fed's funds rate and the U3 rate. You know, I know I'm sort of throwing a lot of information at you, but we saw those crossovers of the Fed's fund rate against unemployment, remember? And then we saw that lag. Now, we know that that initial claims is starting to come up. We're concerned about it because of what happened in the first oil crisis, second oil crisis. We can see that there is a perfectly good argument to be had that unemployment is going to act as a buffer. Why is that a good argument? Because it lags. We're not going to see that effect now. All right. But if that stochastic hits 50, all right, that argument goes out the window. And then I wonder if there is sort of admissions of, well, we got it wrong this time. Okay, which is what we've been hearing all the time. We've been hearing transitory, we got it wrong. You know, central banks just seem to be a little bit behind the curve in this, and these charts just to me seem quite foreboding. Now, so that's the initial claims that we've spoken about. Let's go through now to U.S. CPI, because that's the key metric for today, and then we're going to end off with DAX. Okay, so let's go through now to U.S. CPI. So let's bring back our. Let's go through to, and what we want to look at is core. We want to look at core. Okay, and I'll tell you why we want to look at core. We want to look at core because there's very little that a central bank can do with headline inflation. The volatile items, energy, food prices that are taken out of headline so that the central bank can measure core, they do that because that represents the demand side of the economy. That's the side of the economy that central banks influence. So that's why we're looking at core there. Okay. Rob's also saying he was reading that because it's so hard to recruit staff, companies are not laying off, and perhaps a better measure is new hires. Or I was thinking hours worked. Hours worked is definitely a top metric. We did cover hours worked. We did cover hours work. I think again 2 weeks. It is dropping. Rob, I think we should revisit it. I haven't prepared the data for this morning, but you're quite right. Hours worked, and so unemployment is lagging. Initial jobless claims is coincident. Hours worked is coincident because instead of laying off staff, companies, first of all, they don't like laying off. I would imagine most people are uncomfortable laying off other people, just in terms of human nature. But of course, we've got to make business decisions, and also there's a cost involved with training. So I think there's kind of an emotional component, and I think there's a business cost component as well. So that's why it tends to lag. So I would definitely agree with that, Rob. And we should, by the way, we will need to look at that again. Today, we're going to also see U.S. Consumer Confidence come out. So I think we need to look at the consumer again after the University of Michigan releases its series, and we can tie the hours work there as well. All right, let's just take a look at U.S. CPI. I want to go monthly here. I want to take the stochastic out here. The way I want to look at this is I want to add in a 12-month exponential moving average. Okay, so I want a fast moving 12-month so that we can kind of get the best, I guess the quickest reading for when inflation has peaked. So we just put in an EMA. Okay, and let's just do a little adjusting here. I'll make it sort of a bright green so we can all see it. And I just want to adjust this to 12. So that's on a monthly scale. Are we looking at a monthly chart? Let's make it a monthly scale. And what I want to do is put in our RSI. The RSI adjustments we're keeping as per our usual settings. So let's throw that in. Okay, so just to highlight our settings, we use a 10 high-low divided by 2, so a median, right? And then what we will do here as well is we're actually going to add what we're going to do here, we're going to add a average to this, which is built into TradingView. Just going to make this black so it's easier to see, make it a little thicker. And then I'm going to just adjust this to a 9 period. And again, we'll make it a bit faster. Okay. So I've got a 9 period signal line. Okay. So now we've got a really good way to see if inflation is peaking. We will be slightly late, but we would be more correct. Okay. So instead of guessing, what we can say is, well, what we want is we want the RSI to dip below its signal line. Okay, We want it. Now, take a look. This coincides with the first oil crisis. Okay, and then after that happens, the next signal that we've peaked is, of course, the CPI crosses below its moving average. We go to the second oil crisis. Go to the second oil crisis. There's the crossover. So interestingly, these are the these crises link up with our current crisis because the RSI for all three of these are all over 80. They're all in our excess area. Very rarely, besides perhaps a slight spike over here in 91, have we been as overbought, not as overbought as this, right? So I think it would be quite sensible for us to want to see the RSI dip below its signal line, because that seems to have been the pattern with the oil crises. Now, it is worth making an obvious statement, okay, is that we're basing this type of analysis. On just 2 data points. Well, that's tiny, all right? It's to make it any sort of statistical inference of 2 data points is not scientific, you know. But I mean, this is about the only times I can think of that the variables are similar. Okay, so this is all we've got to work on now. So if that's the case, then I think that an RSI dipping below the signal line is certainly appropriate. And if that happens, well, then we want to see the CPI, and this is core. Okay, we want to see the core CPI dipping below its 12-month exponential moving average. I think if we get those 2 technical signals, we could agree in principle that inflation has peaked. We can't say it with any sort of absolute authority. It may dip and then pick up again. I don't know. You know, these things tend to have a life of their own. But the indicators will tell us that inflation is picking up again. In other words, the CPI, the core CPI, will move above its moving average, or the RSI move above its signal line. So the idea here is there might be a moderation in inflation. There might not be. I see no evidence that inflation has peaked. What I do see evidence of is that we are near a peak. So yes, I think that it could have peaked. But what happens if the core CPI moves from 5.83 to 5.9? Well, you know, I think that's feasible. And how many times, and I don't have the answer for this, how many times in the first oil crisis and the second oil crisis were economists saying, well, it's we're going to see core CPI peak, and let's say the calls are made there or there or there or there. I don't know the answer. But the point is, whilst I think we're near the apex, I certainly don't know if we have peaked, but I would be much more confident if we get the RSI dipping below its signal line. Then I'll be much more confident if we get the actual core CPI moving below its moving average, because then not only has it peaked, then it's actually starting to come down. That changes everything in terms of macroeconomic analysis. Okay, then things become potentially more expansionary, but we're not there yet. So to say that the Fed may be less hawkish in their monetary policy, well, yes, they may. They also may not. You know, so let's just see how that plays out. All right. The next thing that we need to look at is, of course, the Bund, and then we're going to end off with the DAX. So let's just bring that up. All right, so I'm just going to take this logarithmic. It's distorting the chart here. Let's just move this back to normal candles. All right, so let's go to the weekly as well. All right, so I mean, you can see the bund for this week has been really strong. It's been really strong the last 2 weeks. If we go down to the daily, you can see a very strong blue candle yesterday. The daily is overbought, and the weekly is overbought again. To me, that suggests some sort of short-term ceiling on the price. President Lagarde went ahead. She said 25 basis points. I think that's discounted in. You know, I've been hearing and been expecting 25 basis points for July for over a month now. You know, so I think that's very much where it gets interesting now is what's going to happen in September, because 50 is not baked in. 50 is not baked in, and that's now a real possibility. Okay, so any sort of moderation here on the daily or the weekly, I think would be setting us up potentially for a 50 in September. Of course, being very much dependent on the inflation data. But again, I don't know if that inflation data is going to moderate. You can see how we're tying this together now. We've got to keep an eye on that. There's no indication that this CPI has peaked on a technical basis. The only suggestion is, I would say we're pretty close to the apex. Okay, I think that's about as absolute as we can get for the time being. Let's just go now through to DAX. Just before we get to DAX, we must mention US dollar. So yesterday we mentioned we're looking to see if we're going to get a higher trough. The dollar's been very strong. Okay, we're moving now back into zone 1. This is going to be an important instrument to watch come the CPI release. Okay, so it's going to either entrench the higher trough, or we're going to get a pullback towards last week's high, and then we're going to have to make a sort of a judgment. But US dollar very strong, and the higher trough now seems almost locked in, but we've got a huge hurdle in front of us, right? And that would be 12:30 GMT, 1:30 UK, 2:30 ZA. We're going to get the CPI announcement. Let's just bring up DAX. This is going to be our last chart for this morning. Now, after the central bank press conference, the DAX really was being sold down heavily. Let's just now remember the Bund. The Bund is looking to me very frothy. It's looking very much as if there has to be some sort of normalization. Now, if there's some sort of normalization, it may actually benefit DAX, but I think we must be cognizant of the fact that that is potentially setting up for a big move September, and that could hit DAX quite hard. So that's sort of I guess a topic that we're going to have to try and tackle. Take a look. Technically speaking, the yesterday's ECB meeting hurt DAX. Guess where it hurt it? Right at our resistance area. Right at our resistance area. We go back now to the daily. Now, this is very, I think, important for us. I'm going to again go back to the fact that yields, European yields, do look overcooked, right? If they overcooked, well, we haven't dropped into zone 3 yet. We're still in zone 2. We may as well just take a look at this on a Japanese candle basis, just to be consistent with our analysis. All right, so it is actually in zone 3. However, what I will say is that this zone 3 candle, hasn't completed quite yet. All right, so what I am nervous of is that there is some sort of normalization of yield on the German Bund that may push money back into DAX. Okay, if it does, we may actually end the day in neutral. So just be careful of that. I think that's a risk. And if it doesn't happen today, I think it's a risk that we'll carry into next week. So we go now to the hourly chart. And to get into the DAX in any sort of short position is going to be very difficult. We are long into this move. Okay, we're long into this move. You can see it started here. So again, risk reward here, just you need to be a little cognizant of that. Some sort of pullback to central pivot R1, even a heavy one back to R2, just as that yield perhaps normalizes. I think is something just to be watching to see if that is in fact happening. Where that breakdown is of course dependent on stochastic. Okay, so if stochastic carries on in this side, well then the DAX is going to get hurt badly today. But that's very much dependent on if we maintain this level here. You can also see we are very close to this oversold level, and this oversold level probably hits a floor underneath it. Incidentally, what's quite interesting is just how long it stayed oversold yesterday, and I think the reason it stayed oversold for so long yesterday is because of the ECB. Remember, for 18 months, the ECB was basically a snooze fest. Yesterday, it was so important, and I think President Lagarde did a really good job of sort of outlining the steps forward. I think her communication is really good. So I think that the downside risk here is certainly my ultimately, I think we are heading lower here, subject to correction. But be careful, the move's done. Okay, to get in now, you really are relying on the market to keep the downside momentum. That might not happen given the oversold condition. Sort of on the hourly, it may not happen because yields, I think, have a ceiling on them as well now. All right, I think that's where we're going to stop for this morning. If there's any questions, please go ahead and type those through. The questions, go ahead and type those through. All right, nothing coming in. So let's conclude here, guys. I want to wish you a good day, a terrific weekend, and we'll catch up on Monday. Thanks very much, guys.